Let's start with Tina and oil, which in New York just capped its biggest annual increase since 2016. Tina, 2019 looked good, but I keep hearing that the word vulnerable is the word for at least the first half of 2020. What's your take?
Yeah, I think that's correct. I mean, certainly what we heard from OPEC the last time that they met was that there are concerns about what the first half of the year is going to look like in terms of inventories. That's why they took the extra added step of drawing another 500,000 barrels a day out of the market. I think you'll have to look for that. We certainly want to be looking at the March 5th and 6th meeting that Vienna will have, that the OPEC will have in Vienna, both with the OPEC members and their allies, to talk about kind of next steps. And that'll be a good time as a placeholder to sort of see if what they have put in place already is working or if they need to take more aggressive action.
Tina, what should we expect from shale in the U.S.?
Well, I think we've heard for a number of years about how there'll be more consolidation in the industry. What we're looking at more closely, though, is what's happening with regulations around shale, and specifically what's happening in Texas in terms of flaring permits. We certainly saw a little bit of an indication over 2019 that the agency might actually want to be reducing the number of flaring permits they've allowed. They've never rejected one so far. But there will be a November election for the Texas Railroad Commission, and we'll get a sense then of whether people in Texas are tired of seeing that much natural gas burned off as opposed to captured.
That brings me to Joe. In 2019, it was a rough year for steel. The year before, President Trump boasted that his 25% tariff on steel imports was reinvigorating the country's steel industry, but it doesn't seem like that was the case. Joe, what fueled steel's downfall?
I mean, basically, after the tariffs came in, it encouraged a lot more buying of domestic production. It also boosted profits for most of the steelmakers, which meant all of them started bringing back online downed production. So you had more production come online at a time when demand started falling out of the economy in 2019, and so that left you with a lower steel price. Going into 2020, the question is, well, how much demand is really going to be there? There's uncertainty in every election year. You know, things were so good last year in the stock market, sure, but we've seen manufacturing fall off in the past 5 to 6 months. People aren't sitting around being too optimistic, but I haven't heard people saying, you know, this is the end-all, be-all, right?
Joe, I also keep hearing calls for 1,600 an ounce on gold in early 2020. What is driving gold and some of the other precious safety metals higher?
Yeah, I mean, so we're just talking about the uncertainty, right? Uncertainty is a time when people are buying gold. We see the uncertainty in the U.S.-China trade relationship. There's uncertainty maybe this upcoming year for an U.S. and EU trade relationship. And of course, you have the election. And so all of that coming together leaves people a bit uncertain. And so they're moving towards these haven assets, including gold. I don't know if we'll have another 19% gain this year, but it's certainly something that investors will be keeping an eye on.
Well, now I want to turn to soy. Now, the year ended on a high note. Thank you to American soybean farmers. Thank you to trade optimism. But China's swine flu and unpredictable weather patterns threaten any long-term confidence. Joining us now with more, it is Bloomberg's agricultural reporter, Sterling Smith. You know, Sterling, big drop in production here in 2019 relative to 2018. How does that set us up for 2020?
Well, that protected us from having a big collapse in prices. Had we seen all the acres that the farmers intended to plant get planted, our ending stocks would be sitting at 1.3 billion, as opposed to sitting right now at about 450 million. If the farmers plant all the acres that they're thinking they're going to, which puts us back up in that 85 million area, we're going to be looking at a big supply of soybeans, assuming the weather behaves okay. Now, we've had some issues with the weather already. I was in Chicago last week. It was 60 degrees at Christmas time in Chicago. That's not normal. So we are setting ourselves up for a weather situation. On top of this, we really have to look at what the situation is with the Chinese hogs. Hog supplies are going to be very, very small, and that's going to hurt demand for soybeans. So we do have a situation where we could have a real problem again with prices.
I keep hearing that people want to tie in calls to a stronger or a weaker dollar and sort of how that fits into the soybean picture. How are you folding in that analysis into the outlook for soy?
Well, if we do see a weaker dollar, which I do think is a possibility that we will see some decline in the dollar, that will work to put a floor underneath the price of soybeans. But we have to weigh that against the South American crop, which is already looking to be 6 million metric tons bigger than last year's and could easily find itself maybe being 8 or 9 million tons bigger, so we would have that additional supply, which would likely offset any strength granted by a weaker dollar.